24 seconds away from the opening bow this morning. Good morning. Looking to open up the session this Friday, close out the week and close out the month. On the Nasdaq on the month, down almost 10%, heading for the worst month, the biggest monthly decline on that particular index, going all the way back to 2008. Futures right now, negative. Switch up the board and get to the bond market. Yields higher on a 2-year, on a 10-year by 10 or 11 basis points. The 292.58 going into the Fed next week, coming off the back of an employment cost index that surprises to the upside. Euro dollar pulls back from session highs, 105.26 and positive 0.25%. Europe has its own inflation problems, 7.5% on CPI, and core heading in the wrong direction for this ECB. Crude hanging in there, 106.61. A ton of corporate earnings from the oil patch we need to talk about. Crude up by a little more than 1%. Let's break down the movers and cross over to Candy Lines.
Well, John, there's really one mover that matters the most today, and that would be Amazon. It is absolutely plunging at the opening bell, down by double digits, around 11% after that disappointing revenue forecast. The company basically saying we overinvested in people and warehouses during the pandemic. Now it's looking like demand may be fading. That stock down heavily as a result. Apple only opening by about 1.2% lower, so well off of the pre-market lows. But of course, the issue there is the warning around a potentially $8 billion hit on revenue in the current quarter due to supply chain challenges in places like China. You were talking about big oil as well, John. Exxon up about 0.6%. Its profit doubled due to higher oil prices. Chevron reporting the highest profit it has seen in almost a decade. And of course, the story with Exxon also includes a $3.4 billion charge due to the planned exit of its business from Russia. But no worries, they still have plenty of cash to return to shareholders, tripling that buyback to up to $30 billion, John.
Not shy about it, are they, Kaylee?
Not at all.
I thought they might be, but they're not at all. Kelly Lines, thank you very much. What a month it's been on the Nasdaq. The Nasdaq 100 heading for its worst start in about 2 decades, the worst start to the year. On the month, we are down by almost 10%. We have shedded $1.8 trillion in market value this month alone. Taylor Riggs, the numbers are staggering.
The numbers are staggering, John. And Kaylee sort of already took us through sort of the quarterly results and what we heard last night. But it's Apple, it's Amazon, and then really it was Intel as well. Hard to sort of not feel here for Pat Gelsinger, of course, sort of being brought in. But our very own Mandeep Singh, of course, also saying that this is just a big ship to try to turn around. And indeed, they need more time. So you're also sort of getting the sense that big tech here, at least on Intel, is certainly to the downside. The Western Digital, a little bit to the upside here. And we've heard similar sort of positive stories from some of the other chip makers as well. So really been a push and pull here, but overall big tech, like you said, it has just been bad. I want to sort of put into some size and scope here. I was taking a look. Google on track for its worst month since 2008. So it's been a bad April. Amazon on track for its worst month since 2018. It's been a bad April, and it's been a bad April pretty much across the board, if you can see there. I think what's interesting, and you can talk to Dan Ives about this, is sort of the increasing bullishness, though, despite this. I think going forward, we've been taking a look at where sort of analysts are thinking about estimates for the NASDAQ 100, still looking at sort of the year-end price targets on a 12-month basis of about 17,000. So that's showing a pretty sort of bright future if you think about where we are now, John.
I was going through the analyst page on Amazon, Taylor, just going through the ratings. 57 buys, 1 hold, 1 sell. The South side's still in on this name, and this name has struggled for more than just a month.
And ask about the price split. I think we were asked Poonam Goyal, of course, over who covers Amazon for us here, and still going through with the split of about 20-1, if I'm correct. Of course, we know on a fundamental basis that doesn't make a difference. Does it help when we think about the weightings of how it is within this index? But again, Andy Jassy sort of addressed this, saying we've been here before. We've talked about losses before. It takes time to turn it around, but it's not new to the company. If you think about the origins of this company and the losses, they've done this before and they've been successful. That might be where the hope is for this company.
Taylor, thank you. Amazon down by more than 10% in early trading. Apple actually coming back, only down by 0.2%. Dan Ives of Wedbush is still bullish on this name in a big way. This is what he had to say. The China and supply chain issues should peak in the June quarter and then subside into the key September and December quarters. This is not a reason to panic and sell the stock. Still got an outperform rating, still got a $200 price target, joins us right now. Dan, why don't you see a demand problem in quite the same way that others might?
I mean, because ultimately, if you take out the 4 to 8 billion, numbers are going up by 3 to 4 billion. In other words, the underlying demand is stronger than the street anticipated. Now, look, the COVID shutdown in China clearly hurts them in terms of the June quarter, and it could ultimately trickle into September. But John, we continue to focus on the demand story. I mean, that continues to be the key why you buy Apple. Selling it on the 4 to 8 billion hit this quarter would be, to me, that would be the wrong move. That's why we've been telling our investors last night, this morning, this stock's down every day of the week you're buying this because of the demand story from iPhone services.
Well, they're already buying it off the lows right now, 163.70. The problem people have, I think, Dan, beyond just a single name, is how to value any of these names in this current environment. I caught up with Brent Thill at Jefferies. Take a listen to what he had to say.
Pushback right now is no one wants to buy anything in tech. So it's not just Amazon. Go pull up a chart on Microsoft. Go pull up a chart on Google. Pull up a chart on anything. We are in a buyer's strike across Wall Street on software.
Dan, I think this is the problem that you and a lot of very talented analysts have right now on many of these names, is that the story might make sense from a single name perspective, but they're all getting thrown into the same bucket. You've been looking for bifurcation in the sector. I'm trying to work out whether you see that in the numbers, one, and two, why you think the market's going to start telling that story, seeing that story in quite the same way anytime soon.
Well, first, I think the bifurcation you've seen in tech earnings this week. You look at cloud, strong, Microsoft. You look at what we saw from Qualcomm, even the cloud numbers coming from Google, from Amazon, and then, of course, Apple in terms of what we saw there, and even on the 5G play. The have-nots, okay, the e-commerce piece of Amazon, Netflix, and some others, and even Meta was better than expected. Look, I think it's a have and have-not. I think it's enterprise, cloud, cyber, semis. That's what drives us higher, along with Apple. What drives, and ultimately work from home, names, those could continue multiples to compress. Starting to happen on Alphabet as well, on the GCP piece, because you're looking at the cloud transformation. I call it a fourth industrial revolution. That's why Microsoft's numbers were so strong, because they're really a pure play cloud name. Amazon, I think what gets lost in the noise last night is that AWS piece, I mean, that's really going to be on a run rate of, 80 billion plus in terms of where it's going. I think that's something where the street more and more is going to start on some of these valuations to do some of the parts, because I believe what's baked into some of these tech stocks is just, I'll call it Category 5 hurricane headwinds.
The whole of the South Side agrees. I'm going through all these notes right now, Dan. This came from RBC. Inflation, underutilized readied capacity, and tough comps are something of a perfect storm, but are now also better baked into Wall Street models, making the setup from here positive. The stock's down 11%. I get you want to lean the other way here, but does the response of the market to these numbers, the numbers that you say are strong and still okay, Dan, is the response to these numbers tell you anything at all?
Well, I can tell you right now, I mean, it's as nerve-wracking talking to investors that I'm hearing inbound as I've seen in the last 6-7 years. Because right now, I mean, especially from an institutional perspective, you could be right on quarters. Stocks are not reacting as you'd expect. And I think anytime that happens, the dislocation, everything is getting sold here. But again, I keep going back to the enterprise, the cloud stories, the cyber piece. That continues to move forward. And I think even in Apple, we could talk about 4 to 8 billion. But ultimately, I think the headline is that the demand story for Apple is Teflon-like. And I think that's important. And I think it can easily get lost in noise. But we're in just one of those markets. There's going to be many, really yelling fire in a crowded theater.
China. Is it really Teflon-like, Dan? Nomura in the last week are looking for a 3 handle on GDP in China. We know China's an important factor on both the supply side and the demand side for this company. Can you really call that Teflon-like demand, Dan, given the lockdowns taking place in that country?
I call it Teflon-like relative to expectations. If you look at China for Apple, you still have more than 50% of the customer base that have not upgraded to the next iPhone. And especially more and more going higher ASP. And it's relative to what's baked in here. I mean, China growth was called low single digits, Street's baking in negative growth. If anything happens slightly positive relative to expectations in China, I think a lot of these tech stocks rip. And that's sort of our thoughts. Our thoughts are relative to how we're sort of setting up into the second half. And especially obviously with the Fed rate cycle now is sort of taking hold. I just believe a lot of these tech stocks, specifically names like Apple, Microsoft, among others, especially on the enterprise stores, I think these are way oversold.
Well, we're certainly in positive territory now on Apple, positive almost 1/10%. On Amazon, a very, very different story. Dan, wonderful to catch up with you over the last week. Been a good friend of this program, just guiding us through the stories. He's staying bullish. Dan Ives there of Wedbush. Apple's up by a couple of 1/10%. Amazon looks like this. It's down by 11 full percentage points. Coming up, Democrats facing inflationary headwinds ahead of midterms.
I think we're going to be in real trouble if we don't get up and deliver. Then I believe that Democrats are going to lose.
That conversation just around the corner with the National Economic Council Director, Brian Deese from New York. This is Bloomberg.
Good morning, John. Inflation is definitely the key issue for the Democrats heading into the November elections. But just yesterday, we heard from the president's top Treasury chief, Treasury Secretary Janet Yellen, and she made no reference to inflation. And she defended the Biden administration's stimulus package, which obviously draws a lot of criticism from Republicans. They say that this is fueling inflation. The issue, Jonathan, is that at this moment, there's really two big items that are top of when you look at consumers' mind, and that is gasoline bills and grocery bills. And the Ukraine war has just exacerbated these problems that were already there. When it comes to gasoline, we've seen what the administration has done, which is, of course, the SPR release, the ethanol play this summer. Now what you're potentially going to see on the Hill, you have Senator Schumer and Speaker Pelosi talking about beefing up this authority for the FTC to go after companies. They say this is price gouging. At the same time, you have others saying maybe a gasoline tax holiday. There's very little at the moment they could do to try to quell these prices, and they only have a few months, Jonathan.
Anne-Marie, thank you. Let's talk about that now. This was the White House's response to the GDP print from yesterday. They said the following: while last quarter's growth estimate was affected by technical factors, the U.S. confronts the challenges of COVID-19 around the world, Putin's unprovoked invasion of Ukraine, and global inflation from a position of strength. Lucky this morning to have Brian Deese with us, the U.S. National Economic Council Director. He joins us now. Brian, first of all, thanks for giving us some of your precious time. Let's just start there. The optics aren't great. Q1 GDP negative, inflation 8.5%. How do you explain to the electorate right now that things aren't as bad as they feel like they are?
Well, we're in a moment where the economy has some significant strengths and some very significant challenges. As you just pointed out from last quarter's GDP print, what we saw was a continuation of strong consumer spending, business investment, residential investment, and we saw the technical factors associated with inventories, but even inventories building as businesses come back from the most acute supply shocks of last year. And at the same time, we face real challenges. The war in Ukraine is putting upward pressure on prices at a time where that's not what we need. And we have a challenge of price increases across the board that we need to tackle. So what you see from the president and this administration is waking up every day saying, how can we operate from this position of strength? The United States is uniquely well positioned among almost every major country in the world. What can we do to try to help address these issues? And our focus right now is on measures, practical measures that can lower costs and lower the deficit. That provides relief to families across America and also would help counter inflationary pressures as well.
Let's talk about that policy effort. Chevron this morning just announced the biggest profit in a decade. They expect to keep overall output either flat or down to 3% this year. Exxon just delivered a $30 billion share buyback. What's the policy response, Brian, to that?
Well, number one, we have said we need to see more production in the United States. The market provides every incentive that companies need to produce more, and we are encouraging companies to do so. As you noted earlier, we took the extraordinary effort, the president took the extraordinary action of releasing 1 million barrels a day from the Strategic Petroleum Reserve for 6 months. That is a bridge to a period later this year into Q3 where the industry themselves have said they intend to increase production by about 1 million barrels a day. We want to see that happen, and we're also taking steps to try to ensure that. For example, putting a fee on leases and leased areas where companies are not producing. If companies are going to hold a public asset and they're not going to use it, then they should pay more for that. Those are the kinds of things we're focused on the immediate term to try to get more supply onto the market, while at the same time being very focused on what we need to do for the long term. And what we need to do the long term is provide technology and neutral incentives to drive the entire economy toward cleaner energy.
Is there anything you can do on the tax side for the consumer, given where gas prices are?
Well, we're looking at all options. Everything is on the table. The goal of increasing supply, just to be very clear, is to provide relief to the end consumer, because we are supply constrained in the current oil market because of Russia's invasion and because of Russian barrels coming off the market. Bringing more supply online should help to bring prices down at the pump. That's in the immediate term. We've seen some relief from last month, but we want to see those prices come down further. There are other ideas out there. Congress is looking at them. We're engaged in that debate actively. Everything is on the table, and you've heard from this president as he went to make the ethanol announcement that you referenced a couple of weeks ago.
Yeah.
Wherever there's a practical tool, a sensible tool that will help provide some consumers relief, he's absolutely open to that.
Is student debt forgiveness a sensible tool?
Well, you've heard the president talk about this. We've got a significant challenge in the country of millions of Americans who are burdened by excess student debt, and it affects their decisions. It affects their life decisions, their economic decisions. And so it's certainly something that we are looking closely at as well. We have extended forbearance on student debt as we continue to face uncertainty of this economy. I'm not going to get ahead of the president. As you heard from him yesterday, it's something he's looking closely at, and you should anticipate we'll probably have more to say on that issue in the next couple of weeks.
I don't expect you to get ahead of the decision. I would like to understand what you're considering. What are you considering?
Well, as of for the last multiple quarters, we have had forbearance on student debt payments, which has been part of the policy response, including, for example, a moratorium on evictions and foreclosures, so that as we navigate through this very complicated economic period, we're trying to provide some relief to American families. As we look forward, the key policy questions revolve around actually forgiving or extinguishing some of that outstanding stock of debt and providing not just payment relief. So that's the issue that we're looking at and the parameters of that.
Controversial decision if it has to be made, and we're going to talk about it a whole lot more in the future, I hope. Brian, fantastic to catch up with you, sir, this morning. Thank you for your time. Brian Deese there, the U.S. National Economic Council Director. From New York, coming up, we'll whip through the trading diary for you and whip through this price action too. What a week it has been on the S&P 500 and on the NASDAQ too for the month. The NASDAQ on the month is down around about 10%. We are heading for the biggest monthly decline on the NASDAQ 100, going all the way back to 2008. From New York, this is Bloomberg. "25 minutes into the session, equities trying to stage some kind of comeback. We're down 0.8% still on the S&P. On the NASDAQ, we're down 0.75%. 10% of the S&P 500, two names. You know it well now. Amazon, Apple. Apple has made a comeback. It's positive 0.4%, in line with maybe the kind of things that something that Dan Ives has got to talk about over at Wedbush. Apple back to 164. Amazon is going nowhere higher fast. down by 12.6% in early trading. That's the price action. Here's your trading diary. The week ahead, the next 24 hours, US PMIs plus ISM manufacturers coming out on Monday. RBA rate decision and the Fed kicking off its two-day policy meeting on Tuesday. A Chairman Powell rate decision and news conference on Wednesday, followed by the Bank of England on Thursday. And finally, we round out a very busy week with a payrolls report. What a week we have coming up for you. From New York City, thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, April 29th. Here at the top market stories we are following for you at this hour. The A's don't have it. Amazon and Apple drop after reporting and take the market down with them. Meanwhile, filings show Elon Musk has sold $8.5 billion in Tesla shares this week to fund his Twitter bid. The EU energy puzzle, Germany says it won't stand in the way of an embargo on Russian oil, but gas remains a question mark. We'll have more on that with the CEO of Naftogaz, Ukraine's state-run energy company. And fuel to the fire, U.S. employment costs jumped by the most on record in the first quarter, heightening inflation fears and sending two-year yields shooting higher. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, it's Friday. It's been another week chock full of earnings and economic data, and we're getting some more right now.
Absolutely. There's two stories actually I want to focus on. We're going to get to the data in just a second. There's a story that's just flashed across the Bloomberg. HSBC top shareholder Ping An said to support a push to break up the bank. HSBC spiking higher on that. It's hard to get HSBC to move in that kind of a way, but it is right now. We'll show you the share price in just a moment. University of Michigan data out as well, which is kind of to the core of what we're really talking about here. Kaylee was referencing what's happening with Amazon. University of Michigan, these are the headline numbers, dropped to 65.2 from 65.7. The market was looking for that number to be stable. Current condition 69.4. That's actually ticked higher, but the expectations number has ticked lower to 62.5. The consumer's feeling good now, but is starting to worry about the story going forward. 1-year inflation expectations stable at 5.4, as is the 5 to 10 number as well at 3%. Kaylee, the consumer is really front and center right now. You look at what is happening in terms of the data we're seeing at the moment. It is absolutely pivotal. US adjusted inflation adjusted spending rising. That was the data we got today. But at the same time, we've also got headlines coming out on Amazon. Amazon's COVID era bailout proves too much as demand cools. I'm trying to figure out how you put those two things together.
Yeah, so am I, Guy, and that's really the dilemma that brought us to our question of the day, which is, what is the best read on the consumer? Is it the economic data, or is it the earnings we're getting out of corporate America? Let's ask Anastasia Amoroso, iCapital Chief Investment Strategist, who is joining me here on set in New York. Also in New York, Michael McKee, Bloomberg's international economics and policy correspondent. Mike, let's first start with you on the data, both UMich that just crossed and that employment cost index from earlier. What's the signal?
Well, the signal is we are still seeing wages rise. Employment costs went up at the highest rate ever in that measure's history, and wages went up the fastest since 2001. But that doesn't mean necessarily that the trend is going to continue, because the PCE data showed wage growth at least slowing somewhat. Now, the issue you ask about, which is a better indicator, I have two charts. I'll just show you the first one here in terms of what people say and what they do. Alan Greenspan famously said, let's look at what people do, not what they say. You can see the white line is what people say is a good time to buy durable goods. It's a terrible time, according to the University of Michigan index. But then look at the blue line, that's the spending that they actually do. So they spend more even if they say they're down.
Anastasia, the U.S. consumer is at the center of the U.S. economy. We've seen a whole raft of companies talking about the U.S. consumer this week. What are you getting from the earnings picture as to the health or lack of health of the U.S. consumer?
Yeah, Guy, I think the U.S. consumer is hanging in there, but there's clear shifts of deceleration in consumption, and also just the shifting pattern of consumption as well. So, for example, Michael talked about the conditions for durable goods orders just deteriorating, and you see that, for example, you see that in the numbers today. You see that consumers are pulling back on buying some of the durable goods, and they're shifting towards services. And I think that's what we saw from Amazon earnings, for example, as well. You saw this deceleration in credit card spending that is being spent on e-commerce. So I think consumers are definitely pulling back, and it's hard not to feel the pinch when inflation is clearly outpacing the wage growth.
Well, and Amazon dealing with inflation headwinds as well, not just in terms of how it impacts consumer behavior, but on labor, on the cost it takes to ship everything in 2 days. How concerned are you around the margin outlook while that held up largely in the first quarter as we move forward through the remainder of the year?
Yeah, I think we have to be concerned for the margin outlook for consumer staples and consumer discretionary. Again, the reality is the consumer is pulling back, and there's not a whole lot of room for error when it comes to margins for some of these, consumption-driven companies. So whether it's Amazon or whether it's another company in consumer discretionary space, we have to be concerned about those, because it's not technology, it's not healthcare, right. It's not even the S&P 500. The margins are a whole lot thinner. So, and I don't know, maybe costs do abate as the year progresses, but again, the biggest concern I have for margins for these companies is that the consumers are starting to pull back.
So the pricing power ability is waning, essentially.
Yeah, that's right. And whether it's housing, whether it's autos, whether it's even demand for energy, we're just starting to see incremental pullback of consumer on, their discretionary spending. So that's going to come to bite some of these discretionary companies.
Mike, how is the Fed going to read this?
The Fed is going to look at it as telling them exactly what they already knew, that wages were rising because companies are trying to attract people back into the workforce, that maybe they are slowing as the Fed expects once people do get back into the labor force, and that the shift, as Anastasia says, in purchases from goods to spending and an overall drop in spending that's no longer fueled by pandemic assistance is going to put some downward pressure on inflation going forward. I don't know if we can go back to that Amazon chart we showed a little bit earlier. It did show profit margins coming down a little bit, but the biggest thing that you have to notice about Amazon is we spent tons and tons of money during the pandemic. Everybody buying stuff from Amazon. Yeah. And I put the red line there, the arrow, to show that's the percentage gain in revenues during the pandemic. Well, of course, it's going to be very high, and it's way above normal. So if things come back down to normal, we should see a normalization of the inflation and spending rates, and that's what the Fed's counting on.
Yeah, no more stimmy checks, Mike, to fuel our online shopping habit. I want to ask you, though, about some research that was out of J.P. Morgan yesterday, essentially saying when you look at the forward outlook for these companies, net earnings revisions are moving lower. The outlook is deteriorating, sending a signal potentially about slowing economic growth, which actually in turn signals that the Federal Reserve isn't going to be able as aggressive as it thinks it can be now. Is it so much about 50 basis points next week, or after they front load, what do they do after that?
Oh, it's definitely what do they do after that. The market is always a what have you done for me lately organization. So the people, the minute 2:01 after we get the decision on Wednesday, people are going to be saying, yeah, but what's next? I don't think it's the Fed that thinks they can raise rates a lot. They want to raise rates up to neutral is kind of what they're warning, but the market's pushing them way beyond that, and that may get readjusted as we see not just the economy slow, but as the profit outlook slow. All of that is what you would expect to happen, and the fact that people are trying to predict a year, 2 years in advance what the Fed's going to do, that's really impossible.
Yeah, there's a lot of uncertainty out there. So Anastasia, we come towards the end of earnings season. We've still got some of the big retailers to report. We're going to learn more about the consumer when that happens. Do we have enough information yet to judge whether or not this market is cheap enough to start to put money back to work?
Well, here's what I would say, Guy. If you look at the market broadly, I don't think it's cheap enough against the backdrop of this earnings revision story that Kayleigh was talking about, which is slowing down. So if you look at the valuations of the S&P and the NASDAQ, they're somewhere in the 40th and 50th percentile over the last 5 years. So that's not screaming cheap broadly. But what I'll say, if you look below the surface, and if you look at the valuations of software and semiconductors, for example, or even infotech and communication services broadly, they're starting to screen pretty cheap. They're now in the 25th percentile or so of their valuations metrics over the last 5 years. But you juxtapose that with consumer staples, for example, that everybody has flocked to, or utilities, and they're actually quite on the expensive end of it. So I think the markets, the participants, are going to need to be really selective here. And it's really a barbell approach that I think you want to deploy here. You want to look for some of those bargains, as we are at the bottom of the trading range right now. They're going to be in software, they're going to be in semiconductors. You want to look for those, but you still know there's headwinds to technology. So I would couple that with some of the dividend-paying stocks that I think that's where you also need to focus in this environment.
Well, and as we're talking about valuations and the multiple you're willing to pay for stocks, obviously it's going to be a story of relativity also, and bond yields have a huge role to play in it. We're at 287 on the 10-year right now. We got a taste of 293 earlier today. Have we seen the peak already, or do you think we're moving higher?
I think it's really hard to say that. I think it's really hard to rule out that this is it and the Fed is not going to be any more hawkish. I think the reality is the economic numbers are still fairly strong. Inflation has not yet shown signs of peaking. So I think the Fed is going to have to be decisive. And they've basically told us they want to do more, not less. And they want to front load some of these rate increases. So against this backdrop where the Fed has this itch to be more and more hawkish, I think it's really hard to rule that out, that we we've seen the peak in rates. And by the way, it's not just the Fed, it's the other central bankers as well. And so as long as they push up their domestic rates, that's going to put upwards pressure on the 10-year as well. So I would rather wait for more clarity from the Fed before calling the peak on the 10-year. And Kayleigh, that's why it's so hard to convincingly say that, yes, this is the bottom that we've seen in the market, because until we've seen the peak in yields, we really can't say that.
Okay, so if that is the case, do I want to be taking more out of the market, Anastasia, than I'm putting into it right now? If I'm selling stuff, do I reinvest it, or do I hang on for a better opportunity?
Yeah, guys, so this is kind of a 2 or 3 part answer. I think the first thing we really want to do is we want to decide what kind of risk we want to take in the portfolio, and that needs to be a lower level of risk that we've seen over the last several years. So the way you do that, you shift to quality, you shift to higher dividend paying stocks, and that's going to be the core of the equity part of the portfolio. You couple that with potentially some opportunities in high yield, leverage loans, private credit, real estate, a slew of the other income producing opportunities. So that's the core. But, you know, I am tempted by some of the valuation resets that we have had in the technology sector. And by the way, amidst the slew of earnings that we've had, it's clear that consumer-driven advertising growth is slowing, and maybe, you know, smartphone demand eventually is going to slow. But cloud computing, you know, digital transformation growth remains incredibly strong for companies like Microsoft, for example. So that's why I think you fast forward, especially a couple of quarters, when you do have much slower economic growth, it's going to be back to tech. It's going to be back to those secular growth stories, and they are trading quite cheap right now. So I think you start legging in there, but perhaps use options to help leg into those. For example, you could sell a put on some of these, you know, cheaply valued stocks, and you collect a really nice premium now because the volatility has surged.
Well, Mike, Anastasia there was just talking about tech, which gets my mind thinking about Apple, which we also heard from after the bell yesterday, warning of potentially an $8 billion hit to revenue because of supply chain issues in China in particular. How influential is China's persistent COVID zero policy going to be, not just to corporate America, but the U.S. economy as a whole, if it persists?
If it persists, it will be quite an impediment. You saw what happened last fall when the ships all lined up off the coast of the United States and couldn't bring stuff in. We were jammed up. Once China opens up again, you're going to have the same issue. And in the meantime, you're not going to be getting all the parts that you want. And you can imagine that Apple is a leading indicator of that, which kind of gets back to what you were asking Anastasia about in terms of the peak in yields. We don't know how bad that's going to be. So we don't know how high the Fed's going to have to go and whether the Fed will have any impact, because if they can't get supplies from China to the United States, higher interest rates isn't going to solve that problem. Lower interest rates isn't going to solve that problem. It's not a monetary policy issue.
Yeah, as one guest told me before, the Fed cannot print ships, so that is an issue we still face. Thank you so much to Bloomberg's Michael McKee, as well as Anastasia Amoroso, iCapital Chief Investment Strategist. Now coming up, why Vladimir Putin cares so much about another one of the former Soviet republics, Moldova. We'll talk to the country's foreign minister coming up next. This is Bloomberg.
Next week, Bloomberg is live from the Milken Conference in Los Angeles. Bloomberg's all-star team will bring you the latest news and speak to the biggest names with the capital, power, and influence to change the world.
Infrastructure is one of our most exciting areas, I think, for future growth.
There's no shortage of capital in this world for a good deal.
This isn't a quick fix. This is a multi-year journey.
Live coverage starts Monday at noon Eastern Time on Bloomberg Television and Radio.
There is growing concern that Russia's President Vladimir Putin has plans for war beyond Ukraine. The possible target, Moldova, which borders Ukraine. With us now from Brussels, Bloomberg's Maria Tadeo, who has an exclusive interview with Moldova's foreign minister. Maria, over to you.
Yes, Kaylee, let's go straight with Nico Popescu. He is the foreign minister of Moldova. And of course, for everyone to be clear on this, you're a neighboring country to Ukraine, but in between the two countries, there's a breakaway region, Transnistria, where there's right now Russian troops stationed there. We heard explosions happening there at the start of the week. And I have to ask you, and I wish I didn't have to, or put it this bluntly, but Mr. Popescu, do you fear that Vladimir Putin is going to bring war to your country?
Listen, indeed, we have a separatist territory. It's called the Transnistrian region of Moldova. We have had 1,300 Russian troops since 30 years ago. But throughout all of this period, the situation has been calm and peaceful in the last 30 years. We've been engaged in a dialogue, in a peaceful dialogue with the Transnistrian de facto authorities, with the help and mediation of Ukraine, Russia, the EU, the US, and the OSCE. So until the outbreak of this war, over 2 months ago, the situation was reasonably peaceful and quiet. Now, of course, this war is making every single person on the European continent less secure, every single country less secure. Of course, this insecurity is affecting us as well, and especially with these explosions that we heard a few days ago in Transnistria. This situation is, of course, far from being easy. It's quite tense. We as a government are preparing for the full spectrum of threats and contingencies. At the same time, in our assessment, Moldova is not about to become an immediate or imminent target for hostile military action. So the situation is, as we speak today and yesterday, it was calm. These explosions are putting a lot of stress. They are increasing tensions. This we know, but at the same time, the situation remains calm, and in our assessment, Moldova is not about to become a target for direct military aggression or hostilities.
Of Russian intervention. But Mr. Popescu, when you hear Sergei Lavrov saying on TV, we hope that Russia doesn't have to get involved in this, doesn't that worry you? We've seen Russia repeatedly deny things, and then that's exactly what they do. Do you worry about this language coming out of the Kremlin repeatedly every day?
Listen, we've been increasingly worried for a long time. As I told you, we've had this separatist conflict for 30 years. We had Russian troops. We always insisted and continue to insist on the withdrawal of Russian troops which are not stationed legally here. And of course, especially in the last 2 months, we are more worried. At the same time, as I said, we're doing our best to keep the situation calm. My colleagues from the government, we have a deputy prime minister in charge of reintegration, has been in regular touch in the last weeks and months with the Transnistrian de facto authorities. Even yesterday, he met the Transnistrian leader. And we are all very clear here, the absolute majority of people living on the legal territory of the Republic of Moldova, which includes the absolute majority of people living in Transnistria, do not want to live in a war zone. There are some provocateurs, indeed, who try to destabilize, but we're doing our best to keep the situation calm. And we're in regular touch with the separatist authorities of Transnistria. And we want to make sure that war is not imported on our territory.
But then, you know, can you tell me about these explosions then? Who did them? What information do you have? I mean, do you have any intel that suggests actually this was done by Russian-backed separatists? Who made these explosions then?
So, as I said, we don't control this territory. We don't have police there. We cannot collect forensics. We don't have access to CCTV cameras. But in our understanding and from what we, we have, of course, several hypotheses that we're working through, and we don't have a clear-cut answer. But at this stage, our understanding is that these provocations and explosions were staged by internal forces that want to stoke up tensions, want to destabilize, want to create more psychological stress, more economic stress, more socio-economic stress for the entire of Moldova, including the Transnistrian region. But nonetheless, as I said, we're doing our best and we hope that this will be, one-off event rather than the beginning of some much more negative trends. And we're doing our best to be preparing for the full spectrum of scenarios, for the full spectrum of contingencies. And while doing so, we're also in touch with the Transnistrian authorities to keep the situation calm.
Sir, just as a final question, however, are you in talks with the European Union about this? Because you say we're doing our best to avoid escalation, but everyone here is very worried about escalation, particularly in this context. Have you been in touch with the European Union about how they could potentially help you?
Absolutely. I'm talking, we have today a delegation from the OSCE, including the OSCE chairmanship, which is Poland. I spoke today on the phone to the Romanian foreign minister, to the Spanish and Swedish foreign minister. In the last couple of days, I spoke to the French and Italian foreign minister. So we're in touch with everyone, with our partners, with our supporters, and we're really working full time to keep the situation calm here.
Well, Mr. Popescu, thank you so much. And of course, we wish you all the best. And hopefully, as you say, these tensions calm down, because of course, the situation right now in Eastern Europe is very fragile, but also very volatile. Thank you so much for joining us on Bloomberg Television today. Guy?
Thank you very much, Maria. Thank you.
Maria, thank you very much indeed. Really interesting to find out what is happening there. Keep an eye on that. Keep an eye on that carefully. Okay, what are we going to do next? We're going to come back. We want to talk about this HSBC story. The stock's spiking massively over the last 10 minutes, beginning to fade a little bit. Apparently Ping An, its biggest shareholder, is going to support a breakup. We'll talk about it next. This is Bloomberg.
About that all day yesterday. It's time now for our ETF Friday. Cathie Wood's flagship ARK Innovation Fund is heading for its worst ever month on record. The ETF is now down 26% in April and has fallen almost 70% from its all-time high in 2021 as stay-at-home names like Zoom and Teladoc tumble. However, investors seem to be keeping faith in Wood as the fund saw $231 million of inflows this month alone. That is what I'm watching, Guy, but I know you are watching that breaking news out of HSBC.
Absolutely. The story around HSBC, fascinating. So Ping An, the huge Chinese insurer, which owns circa 8% of HSBC, has apparently held talks with the bank about splitting it up, about creating a separately Hong Kong listed part of the bank that would basically allow it to crystallize some of the value that it feels is not being realized right now. The rest obviously would remain, I'm assuming, listed in London. This has long been talked about as a possibility. As you can see, HSBC spiking on the back of this news. Neither bank nor Ping An responding at the moment. Keep an eye on this story. This could be really interesting. This is Bloomberg.
We are an hour into the U.S. trading session. It is a down day for U.S. equities, and you can largely blame that on just one stock, Amazon. That is what's leading the losses in the S&P 500 and the NASDAQ today. They're down 1.5% and 1.7% respectively. Amazon down nearly 12%, right now on pace for its worst day since 2011 and at its lowest since June of 2020. Of course, that's after it reported after the bell yesterday revenue guidance that came up short of expectations. They've overinvested in people and warehouses during the pandemic. Now there's signs that demand is softening. You're also seeing a little bit of softening for Apple shares, down about 0.3%, even after a record non-holiday quarter. The issue there, the warning of a potential $8 billion hit to revenue in the current period thanks to supply chain issues. Now, there's other stocks that have been reporting today as well, including Exxon and Chevron. Big oil reaping in big profits due to higher oil prices. They're actually both down a little bit on the back of that today because they still came up short of expectations. But just take a look at where we had come from prior to today. These stocks up about 40% each year to date. Exxon by 42%, Chevron by 35%, thanks to those higher oil prices. WTI crude on 2022 so far up 46%, trading at $107 a barrel. Also playing into this energy story is, of course, not just oil, but gas as well. A lot of question marks this week after Russia cut off Poland and Bulgaria due to the failure to pay in rubles. Some questions on what other European countries are going to be able to do, what does and does not violate sanctions. So you have seen natural gas front-month futures for Dutch futures in Europe fluctuating a lot this week, ending the week about 10% higher, Guy, though I'm not sure we end the week with much more clarity, really, than we started it with.
So many questions around this story, so many unanswered issues that we need to figure out. Vladimir Putin's demand that countries pay for Russian gas in rubles, starting to divide Europe. Poland and Bulgaria, Kaylee, as you say, have now been cut off. They're refusing. Hungary says it has no choice but to comply. The big question really surrounds Germany. Joining us now is the CEO of Ukraine's state-run energy company, Naftogaz, Yuri Vitrenko. Yuri, thank you very much indeed for your time. So we've seen two European countries now being cut off from Russian gas. How do you expect the situation to develop from here? Are you anticipating that the whole of Europe at some point this year will end up either being cut off or cutting itself off from Russian gas?
I don't really think that we should anticipate a full cut-off of Europe from Russian gas, although we advocate and others are advocating a full embargo on natural gas as well, but it would probably take some time. So it's more reasonable to expect such measures as some special duties on Russian gas or escrow accounts. There will be a lot of tensions around natural gas supplies, but I would not anticipate a full cutoff.
Well, and of course, Russia still is paying Ukraine to allow that gas supply to pass through your country into Europe. Is Ukraine willing to sacrifice that billions of dollars, potentially $1.5 billion that you get for gas transit?
Yes, if it can stop the war, because the damage that we have because of the war has already exceeded 300 billion euros. So it's 200 times more than we get for transit per year. So it cannot be compared. And I'm not even talking about human losses. So that's why if it can stop the war, definitely we would sacrifice these revenues. But we don't want to sacrifice these revenues if it won't change anything. If Europe continues to buy Russian gas, Russia just moves all the flows to other pipelines like Nord Stream 2, for example, that is ready to be operating, but it was stopped because of the sanctions. So that's not something that we would like to achieve with just unilateral interruption of gas transit.
So, sorry, just to be clear here, Yuri, are you saying that if Ukraine, if Kyiv decided to cut off gas transit, that Germany would have no choice but to open up Nord Stream 2?
No, I'm not saying it, but there is a risk like this. So there is a risk that Russia will move gas flows to Nord Stream 2, to Yamal Europe, to Turk Streams. There are alternative pipelines that can easily replace all the flows that currently go through Ukraine. And then Russia can start bombing Ukrainian gas transmission infrastructure. It's not happening in the moment. They bomb our distribution infrastructure, but not the transit infrastructure. So there is also a military dimension that we should take into account.
Well, can you talk to us more about the military impact, how you have suffered from that?
Again, we have to be fair to say that Russians deliberately, they do not bomb the transit infrastructure because it helps them just to get more money from Europe. At the same time, they do bomb the distribution infrastructure just to put more pressure on the Ukrainian government to create some humanitarian crises or even a catastrophe in the towns that they besiege, like, for example, in Mariupol or other towns. So we understand that if there is no transit, then the risk of them bombing the transit infrastructure increases.
Okay. At the moment, there is some ambiguity. There's a lack of clarity about how Europe should be paying for its gas, whether or not it should be paying in euros and those euros get converted into rubles. What is your view on this? You clearly indicated throughout this interview already that paying for Russian gas is helping to prolong the war in Ukraine. What do you think Europe should do in terms of the rules here? How would you set the rules in terms of paying for Russian gas? What do you think they should look like?
at least Europe should stick to the contracts and do not allow Gazprom to avoid potential financial sanctions. And so this whole idea about rubles and this conversion is to be able to avoid potential financial sanctions that would limit financial flows to Putin's regime. Because probably you've heard about so-called escrow accounts idea or some price cap that would limit amount of money Putin can get to Russia from gas exports. So European companies can still pay for gas, but at least a part of this money will be frozen on accounts in Europe. So in order not to let it happen, Putin had this idea so that European off-takers of Russian gas, they instruct their banks to convert euros into rubles, and then it's very difficult to stop rubles from going into Russia. So European companies should not help Putin avoid potential sanctions. That's why they should not agree to convert their euros into rubles, as Gazprom insists. And they have all the contractual rights not to agree this blackmail from Gazprom and from Putin.
So what do you say to countries like Hungary that are doing exactly that?
I'm saying that they're helping violent Putin regime to continue this war, and it does not help Ukraine, it does not help Hungary, it does not help the world, because this war already brought so much damage that it should be stopped as soon as possible.
Finally, Yuri, what is the situation like on the ground in Ukraine when it comes to the availability of energy? How do you feel about Ukrainian energy security for the country itself at this time?
As a national company, we're able, luckily, to provide security of supply. We covered all the demands from our customers in Ukraine. We have enough gas in our storage. We have sizable local production that we continue to maintain despite the hostilities. We also are financially strong. So, for example, in March alone, we provided $1.3 billion as hidden subsidies to our customers. We decided not to increase prices. We're very flexible with payment terms, etc. So currently, again, we can sustain, but at the same time, because this war continues, we would need assistance from the international partners, because we're talking about some critical needs of Ukrainian people who are still in Ukraine. It's about 35 million people. They need heating, they need electricity, they need water, and it all depends on natural gas, and it all depends on us being able to satisfy these critical needs of Ukrainians.
All right, on that note, we will leave it. Thank you so much for your time today, Yuri Vitrenko, Naftogaz CEO. We sincerely appreciate it. Now, from the geopolitics of energy to U.S. politics of energy, two big oil names were out with earnings today. Chevron posting its biggest profit in almost 10 years. Exxon seeing profits more than double, boosting its share buyback to as much as $30 billion. But the White House obviously has a view on this. We have heard President Biden say that oil companies should stop prioritizing returning capital to shareholders and start drilling more. We heard a similar message earlier today on Bloomberg Television when Brian Deese, the director of the National Economic Council, spoke to us. Just take a listen to what he had to say.
We need to see more production in the United States. The market provides every incentive that companies need to produce more, and we are encouraging companies to do so.
Joining us now, Cole Smead of Smead Capital Management. He owns energy names in his portfolio like Chevron, as well as the likes of ConocoPhillips. So Cole, as a shareholder, obviously you are on the beneficiary end of it when it comes to the capital returned to shareholders. Would you be adding to that position in Chevron today, for example, as it's down 2%?
Yeah, relative to the S&P 500, a lot of these names are going to do well, okay? Our concern with Chevron is their capital allocation. And what I mean by capital allocation is, they're running their business fine in terms of the operating company, and they're not wasting capital. A lot of the industry is not wasting capital like they had in the past. But they could have used their balance sheet to really generate high returns by leveraging themselves. They have relatively no debt for an energy business, but leveraging their balance sheet to be the aggressor and the acquirer in this era. And that hasn't been going on, and they're paying down bonds. They're more interested in producing income rather than buying back these shares at attractive prices. And we see other people like Occidental Petroleum doing different. I mean, they levered on Anadarko, and now what they're doing is they're reaping all the benefits of those rewards in buybacks planned over the next 12 months. So in most of their capital return is buybacks.
Cole, what do you think of the idea of these companies producing more oil? That's, by the sounds of things, what the administration would like to see happen.
Yeah.
Is that a good idea? The curve maybe not in their favor.
Yeah, no, Guy, you're spot on. I mean, if you look at the curve, the backwardation says no one's going to go out and produce when they have, such lower prices in the future. If that futures curve was higher, there would be people locking those prices in and going out and producing to meet that need. As long as we have backwardation, it's not going to be there. Secondly, the volatility of the commodity. I mean, we're coming out of an equity era where low volatility was the winner. In many respects, the S&P 500 was the low volatility trade of a lifetime. So volatility is a commodity natured type of price movement. And because of that, there's a bunch of investors that don't believe that they want to own these type of assets. And what that's doing is it's just starving the arena for capital to make the investments that these administrations would like, but yet there's no incentives for any financial players to begin entering into those type of agreements.
Cole, clearly energy and these stocks have had a great run so far, but as we talk about a curve that is pointing to lower oil prices in the future, how much oxygen is really left in that energy commodities reliant trade?
Well, I'd say first off, don't look at the futures curve and assume things are going to be terrible. Having spot be this high, it's one of the most bullish things you'll ever see, because the market is just short oil. And like you were mentioning, that Chevron said that jet fuel demand is going to pick up. That is that's one of the legs of this that has not come about yet. I'm going to be doing some travel abroad for the next 2 weeks. That stuff wasn't going on a year ago. So the lack of supply is all you need to know. You can't predict demand. That's a very tough thing to do. But the lack of supply just speaks to very high prices. And when I say high, I mean, we could wake up at $150 a barrel, and we still would not be at a price where we would be hurting American wallets in terms of gasoline spend compared to eras like 2008 or 1973. We'd be still nowhere near that percentage of wallet for the American consumer at $150 a barrel.
Energy is 4% of the S&P. What should it be, do you think, of the average portfolio?
Well, Guy, we own close to 25%. So I know what I want to own. The market can decide to do what they want to do. I think 4 is way too low. Go back to prior eras where we had bad stock markets, like the 1970s that had inflation, or the 2000s where there wasn't much inflation, but it was just a terrible market environment. The big winner in those two prior tough eras was energy. You made wonderful money in energy. In fact, in the late 70s, it was the biggest S&P sector, 30% of the entire market. So I'm not saying we're going to go back to 30% of the entire market, but it would not be outlandish to see this wake up in the teens. And the question is, how do you get there? Is that because the rest of the market does really poorly, or this does really well? Either way, I think we're going to be happy investors.
All right, Cole, you have a lot of energy names in your portfolio. You also have a lot of banks. I see it makes up about 7% of your capital U.S. value strategy. We have seen a dramatic move higher in yields this year, and yet the banks have not been able to keep up. What do you attribute that to?
Yeah, some of it's just the movement. In these banks, they've been really over-earning on their investment bank side. That will go away. It's when the traditional consumer bank and commercial banks really get going. And, I mean, just to give you some stats, I saw the other day, I think Deutsche Bank put this out, Jim Reed did, American households have as much cash as they have debt. So this is a great banking era to lend into to the consumer. Yep. There's a lot of questions right now over things like housing. We don't agree with that. This is a bright economic future. Remember, these banks are old world things. The more frustrating commodity markets get, the more opportunity it creates for banking.
Cole, one final quick question. You said either the energy stocks are going to go up or the market's going to go down. What do you think about the market going down? Bank of America's Michael Hartnett sees pain and exit if the S&P dips below 4,000. Do you see that happening?
Yeah, but Michael's preaching to the choir. We tell people -1% to -2% compounded, including dividends reinvested over the next 10 years. And I don't think we're going to be playing those kind of economics in the energy business in comparison.
Cole, great to catch up. Have a good weekend. Enjoy the travel. Thank you very much indeed for your time. Cole Smead, Smead Capital Management. Great to talk. Thank you very much indeed. Coming up, Tesla shares are up after Elon Musk tweeted that apparently is it. He's no longer selling stock to fund his Twitter bid. Details next. This is Bloomberg. So Elon Musk has been selling billions of dollars worth of Tesla shares, apparently, obviously, which seems like a fairly straightforward line, to help his purchase of Twitter. Filings indicate he's offloaded around $8.5 billion of the stock this week. Joining us now, Alex Webb of Bloomberg Quick Take. This feels logical. We came into the week, how's he going to pay for it? We now know some of the answers to that. Do we know all of the answers to how he's going to pay for it? That isn't quite enough yet.
No, he needs to find $21 billion to fund his portion of it. He's now announced, well, the filings have shown he's going to sell $8.5 billion. The thing is that yesterday he tweeted that he wasn't going to sell any more stock. Now it transpires there is more stock that he's selling. Does that mean there are more filings that are yet to come out that maybe indicate he's selling more? It's just all kind of confusing with Elon. Communication, as ever, as clear as mud.
But on the non-Tesla stock options that he has, where are we in terms of potentially a private equity player coming into this?
Sorry, can you repeat that? When he's in terms of, so he's raised,
like if he had a partner, a private equity firm. for example?
So we don't have a private equity firm in there yet. We've got some banks coming in with financing. Their 44 billion is obviously the sticker price. He needs to fund 21 billion of that. He's got financing for the rest. I think there were conversations with private equity firms. I haven't seen, unless you guys have, I haven't seen any reporting suggesting there is a private equity buyer anywhere near it just yet. The thing that is also kind of noteworthy here is, like, if you're a Tesla investor looking at this, the signal you're getting from Elon is, whether this is intentional from Elon or not, and it's probably not, that Twitter is a better investment case than Tesla, and that's not necessarily something you want to hear.
Yeah, I think you've got to make certain assumptions to make that the case. But yeah, I take your point. Can I just talk a little bit about Amazon? Amazon is the story for me today. Here is a company that is clearly overexpanded during the pandemic. It was the only way to sell stuff, buy stuff during the pandemic. It's the second biggest employer in the United States. It's now beginning to reap the effects of that as we all go back to normal. But AWS continues to power on. We had somebody on, Brian Thiel, I think it was a little earlier, talking about the idea that you get AWS for free. You get the rest of the business free because of AWS. AWS is such a powerhouse. You came on set and you said that's a big problem. Can you just explain that to me?
Well, typically the way you think about antitrust in the US is it a monopoly? i.e., is it the only place that a consumer can buy things? There's a slight pivot going on at the moment to whether it's a monopsony. That means it is the only place that if you're selling stuff, you can sell your products.
Right.
And Amazon, there is a suspicion that it has a too great a say in that sense, that if you're going to sell things online, you have to be on Amazon, because when people try to buy stuff, their first port of call is Amazon. And so the idea then that they can do that at a loss and it's offset by AWS shows that the thing that lawmakers really don't like, they might be squeezing small businesses. And in the US, that is a real pain point, which politically, when they get up on Capitol Hill, they all talk about trying to protect small businesses. If they're able to squeeze the costs on the retail side because they're subsidizing with AWS, that could get into lawmakers' attention.
Well, speaking of pain, Amazon down 12.5% on the back of those results. Worst day since 2011 it's on pace for. Apple, meanwhile, only down 1% after that warning of potentially an $8 billion hit to revenue because of supply-side issues in China. What do you make of that move? It was worse overnight.
Often with Apple, there is some profit taking off by investors after quarterly earnings, whether they're good or bad. The thing is with Apple, it's all about supply here. There isn't necessarily an effect on demand. Now, when is that demand going to come? They've been pushing demand out and out and out because in quarter after quarter, they have not necessarily been able to meet it all. Now, there is going to be a new iPhone coming later this year. Perhaps investors then can think, well, if this demand is pushed out into the next iPhone, it's going to be at a higher price point. That isn't necessarily a bad thing. The thing that Apple has to be careful about is our refresh rates in terms of how often people buy new iPhones. Are they going to be pushed beyond 3 years, which is the current average? 5, 8, 10 years ago, it was every 2 years.
Yeah, especially in the face of this kind of inflation, are people really going to shell out more money to buy a new upgraded iPhone? Thank you so much to Alex Webb of Bloomberg Quick Take, as always, for joining us. This is Bloomberg.
So we're wrapping up the week here in Europe. We're nearly done. Remember, a long weekend coming up for many. Let's take a look at positioning as we're coming through into the end of the week. The Stoxx 600 actually catching a little bit of a bid right now. We're back to 450, but only just. As ever, though, I think the activity has been elsewhere. Euro dollar retaking 105, but still, look at the data that's come out today. Slower growth, higher inflation. That is not a good combination for Europe. You're seeing peripheral yields starting to push out a little bit as well. All of that we are going to discuss next. Barney Buwaja, Chief Strategist at UBS, is going to be joining us. That conversation next. This is Bloomberg.
About that all day yesterday.
Friday, April the 29th. European stocks are higher. So is inflation. Growth, not so much. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
.30 minutes of the European close. Let's check the price action. Stocks are higher. We can see we're bid 450 on the Stoxx 600. We're up by around 0.8%. We're still very much in the middle of the earnings season. There's lots of stocks we need to talk about, but the macro news continues to dominate. European inflation is up. Growth is down. Is a July hike from the ECB now nailed on? Keep an eye on the core numbers to figure out the answer to that question. Euro dollar recapturing the 105 level today, 105.49 after going through 104 yesterday, or 104, having a 104 handle yesterday. The other stock I just want to mention is HSBC. Ping An, the Chinese insurer, owns around 8% of this stock. Apparently it has had discussion with management about breaking this institution up, basically having an Asia-facing business that it will be listed in Hong Kong and putting the rest, or leaving the rest, in London. The stock bouncing on the back of that, up through 5, up by 1.7%. It was a little higher earlier on. We'll try and get more details later on in the program, Kaylee.
All right, Guy. Well, I am watching here in the U.S. markets that have turned even more lower than they were at the opening bell. Of course, it is technology really leading the losses here. The NASDAQ 100 down nearly 2 full percentage points at this point, and you can blame that almost entirely on 2 mega cap companies. Amazon really creating the big drag. This stock down 12% after giving disappointing guidance after the bell yesterday, heading for its worst day since 2011. The issue there is supply issues, including higher costs for labor and for their warehouses, for the logistics that is required to get you whatever product you want in 2 days if you're a Prime member. Then you also have Apple moving lower by nearly 1%. It, of course, warning of potentially up to an $8 billion hit to revenue in the current period because of supply chain issues emanating from places like China. Finally, I did just want to make note of what we're seeing at the short end of the U.S. Treasury market. You did have data coming out of the U.S. earlier today, that employment cost index, which is how the Fed really gauges labor and pricing around it in this economy, up the most